Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Buxton. Check it out. You can really improve your underwriting, your site selection, and your marketing for commercial real estate. Check it out at buxtonco.com. Well, I'm excited about today's show. You know, there's a lot of things going on in commercial real estate. We want to know what's going on now and what's going on in the future, right? We're making moves today that the future is going to impact. Well, we're going to talk about REITs and how REITs are performing. We're going to talk about interest rates and inflation. We're going to talk about the recovery and some expectations moving forward. Now, I think as America's Commercial Real Estate Show has been on air for over 2.5 years, I think we're known for having the best economists and analysts in the country on this show. Well, we have another one today. It's Calvin Schnure. He's Senior VP, Research and Economic Analysis at NAREIT. Now, he's also been economist type positions at the International Monetary Fund, Freddie Mac, JP Morgan Chase, the Federal Reserve. Always interesting to talk to Calvin. Calvin, thank you for being with us, sir.
Michael, good to see you again.
Well, first of all, I'd just like to ask you, how are REITs really performing now? You know, commercial real estate has been going through some changes.
Certainly, we've been seeing a lot of changes. The REIT sector is doing very well in terms of stock performance, investor performance. It's a very strong year, not just the headline numbers being up more than 25% this year. That's way ahead of the S&P 500. You see pretty much across the board, all the property sectors are having a very strong performance. Now, some of this is catch-up. Some of this is catching up because last year the REITs really lagged in the recovery because a lot of people did not trust that the real estate sector was going to have a strong rebound. Now, I've studied real estate sectors, cycles. I've studied what's happened in past downturns. And one thing that you see from that is real estate often lags the rest of the economy in turning around and improving. But once it gets going, you tend to have a very good market. We're embarking on that period right now where there's a lot of differences across the property sectors. We'll talk over the next few minutes what's going on in the different property sectors. But right now we're getting to the point where the real estate recovery is really beginning to gain more traction pretty much across the board. Not completely across the board, but more across the board. And you're seeing that in strong stock market performance. This is a good year for REITs.
Yeah. And REITs own about $3 trillion in commercial real estate assets around the U.S. So it's a significant portion of the properties out there. So Calvin, to put it in perspective, when you look at kind of overall REIT performance of where they stand today, how does that compare to, say, pre-COVID and then right when COVID happened?
Well, performance, I would say, where are they in terms of their overall level? Everything fell last year. We saw huge declines because we didn't know what the bottom was. We didn't know how we were going to get through this. The market stabilized in the middle of last year, and the S&P went on to get back to test new highs, but the REIT market did not until earlier this year. So right now we're back above where REITs were pre-pandemic. So essentially, we've regained all of that lost ground. But you look at the S&P, you look at the Russell 1000, those have continued to push forward to new highs that are well above pre-pandemic on the expectation that with the pandemic behind us, we could have some very strong growth with very supportive policies. The stimulus payments, we have a strong banking system, low interest rates, those are the recipe for a good economy. And the broader stock market really reflects that. REITs are really making strong gains, but are not, compared to where they were 2 years ago, not as high as the rest of the market, but we're certainly on our way there.
Yeah. Well, as an economist that's focused on this real estate world a good bit, what do you think about the recovery and how it's going? I know what's different about it, what and how it might impact CRE.
Well, we're so used to things being completely different from the past. I could pick from a whole menu of points, but the one that I would probably focus on right now is how everything is out of sync. Everything is proceeding at a different speed, and that's leading to some problems. We've seen problems with bottlenecks in production. We've seen inflation spiking in some sectors. The inflation is not an even overall rise in the price level like we've had in some of the periods in the past where it became a problem. It's more some specific items that are going because of these bottlenecks. And that's because it takes a long time to plan to reopen, to hire the staff, to order the raw materials, to get the production schedules, to build up inventories. And the different parts of the economy are on different cycles there. And that means that it's just not a smooth reopening. And that's impacting the commercial real estate sector too, because you don't see all of the parts of whether it's retail or some of the more business-focused sectors opening as fast as we might have thought they would have two or 3 months ago. Everyone thought, well, we have vaccines, it should be smooth sailing, get back to pre-pandemic. It has some adjustment time. We're well into this adjustment time, but it's probably going to continue to be rocky that way for, I can't put a date on it, but I would say for most of this year. And then next year we'll probably have more even, sustained growth.
Yeah. And I want to ask you about the impact of work from home on some of the real estate sectors, like real estate and retail, office and kind of large downtown areas. But before we go there, you just mentioned a bit about the economy and inflation. What is your expectations for interest rates moving forward?
Well, I would say we're almost certain to see interest rates rise, but we've said that before and they haven't always risen. We are still in a low yield, low interest rate global economy. We're seeing a lot of pressures right now with the reopening and price spikes in some of the inflation areas, but in terms of the overall savings and investment balance, what the central banks are doing, we're not going to see a big spike in interest rates. We're very unlikely to see a big spike in interest rates. Now, the 10-year Treasury this morning is trading at 1.27, 1.25%. That's just incredibly low. Of course, that's going to back up as the economy gets more back to normal. I wouldn't be surprised to see it up 50 basis points, 75 basis points over the next 12 months. That's not a forecast. It's just saying, that's getting back more towards a normal range. That's a range where we'd have good financing conditions for commercial real estate. It won't necessarily slow the economy. It's just getting away from the real risk-averse flight to quality type of interest rates we've seen lately.
And let's go to the work from home issue there. A lot of people and a lot of companies enjoyed work from home. A lot of them had struggles and problems with it. You mentioned we have reopenings and companies getting back into their offices, and they're doing it in different ways, different size companies in different markets. What do you think is, when you look at it today, here we are, it's the 1st of August here, 2021, how do you look at that work from home issue today, and what do you expect moving forward?
We're seeing people go back to the office more. We're seeing lots of companies doing a phased reopening where people are coming in a couple days a week, or part of the staff is in part of the week and other people are working from home. We're not going to get a clearer sense until after Labor Day. But if we were to step back and look over the past 18 months, I think one of the biggest surprises is how well work from home really worked. How well a lot of jobs were able to function with all of the technology. I'm doing the interview here instead of in your studio. I've been in your studio. You have a very nice studio. I have a nice home here as well. And I hope that the viewers get a good experience from this. And it's not just this and the Zoom meetings, a lot of other work, accessing files and data, and even collaborative work converted pretty well to being done online. On the other hand, teamwork also just functions better if you see everyone in the room, see everyone around the table. So there's a lot of tension right now. There's a lot of uncertainty about how do we get back the full benefits of in-person meetings, in-person collaboration, while still retaining the flexibility of work from home when it's a productive way of getting something done. Your guess is as good as mine about how quickly that will happen and how completely that will happen. But I can say a couple of things. Early in the pandemic, 37% of the workforce was working from home. Those are statistics from the Bureau of Labor Statistics. They're the ones who produce the employment report. 37%, more than a third. As of June, half the people working from home had gone back to the office. So we were well underway in the return to the office. During the summer, I have not seen a whole lot of companies pushing a complete return to work. It's more after Labor Day that I expect to see the next couple of legs of this return. After Labor Day, when schools are starting, when you have the traditional end of summertime holidays, I hope that childcare facilities are more up and operating. I think then we're going to get a sense of just how close to the pre-pandemic conditions in the office environment we're going to get, and how much people still have the flexibility to work from home one day a week if that's what suits their work schedule.
Yeah. Well, I've seen some people going back to the office that are really excited about it, to get out of their homes and get out and socialize again. And I think one of the things the company leaders think about is onboarding and recruiting and retention and security of their information. The productivity and the culture and the collaboration. It's really hard to do a lot of those things when you don't have people together. And of course, you have some companies that really have gobbled up a lot of office space during this time. So it looks like a lot of companies realize that getting their folks together does have some benefits. And I think for the actual employee, even though we don't like commuting, I guess is the worst part of it for most people, they do like the career advantages, right, of being seen and being around the leadership.
Yeah, that's true. And one of the best ideas that I've heard people discussing is for companies to establish some core hours. Have some time of the week when, for collaborative work, people should expect they're more likely than not to run into people. There's a problem if everyone says, I'm in 3 days a week, but it's a different 3 days and you don't necessarily see people. But if companies may be saying Tuesday, Wednesday, Thursday, from 10 a.m. to 2 p.m. or 10 a.m. to 3 p.m., that's a good time for people to be in the office. If you need to be home someday or just are able to work from home, that's okay. But the bulk of the workforce focusing on those are the days there, you can get the full benefits of collaboration. Now, one reason why people are saying 10 a.m. to 3 p.m. is that eases the commuting rush. One of the areas where people might want to avoid is if you're tightly packed in a bus or in a subway. And if everyone is trying to commute to get to work between 8 and 9:30, the commute's a lot worse than if everyone says, well, let's get to work between 8 and 10, 8 and 10:30. Similar thing on the evening commute. So that's one way that one of the flexible work from home in office models might work.
When you guys recently had your REIT week, from that experience, what did you come away with that maybe surprised you or impressed you with what the REIT leaders are thinking around the country?
A lot of the CEOs were quite optimistic about the recovery the latter half of this year and going on next year. Just continuing with this work from home theme, hearing some of the CEOs of the office REITs talk, they actually say that this flexible work environment may be quite compatible with the demand for office space. Because you think about it, if someone is going to have their space, their office, their cubicle, and that is still designated for them, but they only are going to be in 4 days, 3.5 days a week, and that space sits empty when they're not there. Because one thing that people don't want is more density. People are not saying, well, if people are working from home, we're just going to pack people in tighter and reduce our square footage. That's not really a good public health solution. And I heard a couple of REIT CEOs saying, a lot of firms want some flexibility and they want some greater space in the office, and they're actually comfortable with the amount of space that they're leasing, even if not everyone is in the office every day. I was kind of surprised to hear how they saw that as being relatively benign for their business model, benign for the demand for office space going forward.
Yeah, I know. I've done a lot of business during COVID, and I lead a team that sells office buildings, and we've been doing a lot of business. And when the companies that we've worked with, they're doing a lot of work from home, we notice a lot of inefficiencies there compared to working with companies who are in the office, and they can walk down the hall or next door and get an answer, set up things instead of the work from home. A lot of the inefficiencies there. Well, I don't know that. I'll have to set up a Zoom meeting for next week or tomorrow. And so I think it'd be interesting to see as we feel more comfortable getting around the people, how this changes and how it moves forward. And I'm with the CEOs of the REITs that you talk to in the office world that, I think wellness and having a healthy place, and I don't want to go back to the same desk someone used this morning or yesterday. I want my own space, and I want more square footage per person. So was there any kind of talk about the numbers there as far as square footage per person? Because that had really shrunk to maybe unhealthy levels.
I hadn't seen any numbers specific on the square footage per person, but I don't see anyone saying we're going to continue the increased density that you saw over the past decade. But one of the other things that was interesting, was a bit of surprise, is what we didn't hear. One thing that, a year ago, 9 months ago, when we were talking about work from home and office, one thing that many people discussed was if some business groups that might still collaborate together but did not need to be in the central office with senior management, did not need to be in the most expensive real estate, might move out of the downtown areas into some suburban office parks, or maybe move to a smaller city or regional market where your square footage costs are half of what they were in a big city. And that could have potentially had a pretty big impact on prices and rents in those big city markets, the real prime markets. I haven't seen a whole lot of discussion about that. It seems like most employers are saying, well, we're actually really comfortable having all of our people who are in this main location still in that main location with a little bit more flexibility. That's a positive for the real estate market, for the office real estate that had been a big question mark a year ago.
Yeah, and it's interesting that you interact with the CEOs of all these REITs. I've done a lot of interviews with CEO of REITs, especially at events and conventions, and they really know commercial real estate, and part of the interaction with you guys is one of the reasons they do. So when you hear from the CEOs of these retail REITs, right, I think a lot of people are looking at kind of retail outside looking in and saying, hey, is retail in trouble? What did you hear in that regard?
Well, retail was in the process of redefining what a shopping center, what a regional mall is like, even before the pandemic hit. We think back pre-pandemic. There were all of these stories about more experiences in the food courts and the exercise facilities and so on. And that model proved to be pretty successful. And that model proved to be successful. We're talking about hybrid work from home. Well, there was also a hybrid retail model where you needed both an online presence and also a brick and mortar presence. Most retailers, the stores themselves, have found if they don't have a local brick and mortar presence, their online sales decline. So what the retailers are talking about is saying, well, we need to keep that moving forward and integrate some of the real conveniences that consumers have found in terms of shopping and ordering online with the need to go out and walk around the mall. Sometimes if you're not sure exactly what you want, it's easier to go window shopping when there's an actual window rather than just a screen. You can look at stores and you can see things in a different way, and you touch and feel. So one point is that the retail is really getting back to, and we don't have a real full reopening of retail yet. It's proceeding pretty well, but is getting back to this newer business model that we had. Now, the other thing is within the retail sector, there's a lot of range across the different markets and the different age and quality of the property. There are some markets that may be low growth markets, older markets, older properties, and those are facing some significant challenges, particularly with the ability for e-commerce. But then you look at some of the markets where you have good job growth, high incomes, a lot of density in the area around the mall. Those malls have a really good future ahead of them as we proceed with the reopening.
Talking with Calvin Schnure with NAREIT, and Calvin, REITs and institutional investors have always liked the really big cities, right? The Chicago's, New York's, and San Francisco's. What do you see? And I want to remind listeners, where we are on the date here. We're into July, beginning of August of 2021. What's your view of downtown markets? Like some of these retailers that are in these huge office markets have really been suffering, and some of them really just shut down from it. What's the future of these big cities?
Well, when I was saying that executives are optimistic about the future, right now it's still a hope for the downtown areas because most of the workers are not back to the office. Most of the shoppers are not back into the shopping centers. But a lot of people are eager to go. The future for these centers is probably pretty good, but I don't think you're going to see it snapping back right away. Looking at news from the apartment market, we have seen that some of the people who, on net, not individual people, on net you saw people moving away from the dense downtown centers to suburbs or smaller cities, anywhere where they could get a Wi-Fi connection. That happened in the first 6 to 9 months of the pandemic. Lately we've seen people moving back more. We're seeing pretty strong leasing demand in the apartment markets in the big cities. That gives me some sense that the overall city, the office market, the retail, will follow what's going on in the apartment. Because if the people are there, what's going on in the apartment market. If the people are there, then the workers are there, and the shoppers are going to be there as well.
Well, you mentioned subways and mass transit. It seems like that would be the last markets to come back in recovery wise, because to your point earlier, if I'm going to get in my car and drive up and have 250 square feet per person, I'm probably pretty comfortable. But if I have to cram in a subway and get in an office that's 150 square foot per person, I still might be wanting to wait a little bit, right?
That's right. And I don't have a whole lot of confidence that that'll go smoothly right now. And we don't have data. We don't know exactly what people are doing. But I have a sense that you have more people driving than normally would have been driving before. But if we get back to something where most people are back to the office, the parking lots are going to be full. We need to be able to rely on public transportation, not just because we only have a certain amount of parking space available, but also it's not very good for the environment. We're seeing these fires out west and everything else from climate change. We really need to get back to a model where people can rely on safe public transit to get to work or to get some other place that they need. And I don't think that we have the degree of confidence yet that it's as safe an option as it was pre-pandemic.
Yeah, and it's certainly a great lifestyle to not have to have a car and drive down a freeway and commute and get in the mass transit, have someone else drive, and enjoy all the great things about these large cities. So what would you leave our audience with, Calvin, to think about moving forward regarding the economy or commercial real estate?
I've been an economist for a while, and I've seen some pretty bad crises. I was working on Wall Street on September 11th, 2001, and people were saying, well, no one's ever going to do air travel again, and no one's going to want to work in a high-rise office. And we were worried. That was a real tragedy. It was really shocking. But within 6 months, things were a lot more back to normal than we had expected. And within a few years, we still have the painful memories, but life got back to normal, particularly in the ways that it affects our businesses and our office markets and our downtown areas. 12 or 13 years ago, we had a big crisis with a housing market crisis and mortgage crisis. This economy is resilient. We're going to come through all these challenges that we're seeing right now. And for the longer-term investor, and real estate investors should be longer-term investors. If you're a longer-term investor in holding real estate, and you're looking 5 years down the road, 10 years down the road, I think the pluses much, much, much outweigh any of the minuses right now.
That's great. Yeah, I agree with you. As human beings, we tend to think about what's going on now, and when we hear this dramatic music on the news and how terrible things are and how scary things are, it one of our clients is really giving up their office space and say they're going to work totally from home. And I predict that within 6 months they're going to be really wanting office space again and all the benefits of that collaboration. So you think that real estate's going to do well, economy's going to do well, and interest rates are going to stay fairly stable, maybe go up a little bit over the next year. You said maybe 50 to 75 basis points.
Yeah, I would think that's a reasonable target. Again, I don't have an interest rate forecast. Right now, interest rates are really low, partly because there was the flight to quality and the economy is very weak. That's a typical response in financial markets by investors when you have uncertainty, a lot of risks, And you had a lot of support from the Federal Reserve with their buying program. The Federal Reserve has done a good job of signaling that at some point they're going to stop their bond purchases and possibly raise interest rates. But Chairman Powell said recently that we have not yet seen the substantial progress in the economy. And here I think he's talking largely about the job market. Not seeing the substantial progress in the economy that they need to take away that support. So again, that's suggesting over the medium term, the financial markets are getting a lot of support from the Federal Reserve. Eventually that'll go away. Eventually that will allow interest rates to drift up. But if interest rates would go 50, 75 basis points higher over the next year, that's really still a very good financing environment for commercial real estate, for REITs, for these types of investments.
Great. And you guys have your conference coming up September 20th to September 23rd. Is that right this year? And what type of conference are you expecting? And who might be perfect to attend it?
You know, I'm actually not the person in charge of the agenda for the conference, so I don't want to misspeak on that. But NAREIT does do an awful lot to bring REIT executives, real estate industry professionals, and investors together to discuss the state of the market, to discuss the outlook for REITs. And I would encourage anyone who's active in the REIT space to contact NAREIT to find out more information. And
do they have to be a member of NAREIT to attend?
They're by invitation, and you can talk with our membership and our meetings team to find out. I don't have the full information. There are many people who are members. A lot of people who are professionals in this area find it very helpful to be a member of NAREIT. You get a lot of benefits from that, including attending these meetings. But I don't know the specifics about the attendee list.
Yeah, and you can find out more at REIT.com, and there's also some other great informative articles and resources at REIT.com. Calvin, sir, thank you for joining us again. We always appreciate having you on the show.
It's been my pleasure, Michael. Nice talking to you.
All right. And thank you for joining us around the world and around the U.S. Please let us know what you think. Thank you for connecting with us, rating the show, sharing the show. We really appreciate you doing that. And until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert-level commercial real estate broker training. Cloud Access 1, up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.